This question examines the distinction between financial leverage and operating leverage, two fundamental concepts in corporate finance. Financial leverage refers to the use of debt financing in a company's capital structure. Debt creates fixed financial costs, such as interest payments, which magnify the effect of changes in operating income, EBIT, on net income and earnings per share. As a company uses more debt, its financial leverage increases, along with its potential return and financial risk. In contrast, operating leverage arises from the presence of fixed operating costs, e.g., depreciation, rent, salaries in the production process. Operating leverage measures how sensitive EBIT is to changes in sales volume and is unrelated to financing decisions. Therefore, adding debt affects the financing side of the business rather than the operating cost structure. Students should clearly distinguish between these two types of leverage, as they are tested frequently in finance and management accounting examinations. A. Increases its financial leverage. Correct. Debt introduces fixed interest obligations, increasing the company's reliance on borrowed funds and therefore increasing financial leverage. B. Increases its operating leverage. Incorrect. Operating leverage depends on fixed operating costs, not on debt financing. C. Decreases its financial leverage. Incorrect. Adding debt increases, rather than decreases, financial leverage. D. Decreases its operating leverage. Incorrect. Debt financing has no direct impact on operating leverage because it does not affect the firm's operating cost structure. Correct answer, A. Increases its financial leverage. Key takeaway: the use of debt in a company's capital structure increases financial leverage by creating fixed interest expenses. While this can enhance returns to shareholders when earnings are strong, it also increases financial risk because interest payments must be made regardless of operating performance. This question tests the concept of the degree of financial leverage, DFL, which measures how sensitive earnings available to shareholders are to changes in earnings before interest and taxes, EBIT, due to the existence of fixed interest costs. A DFL greater than 1 indicates that the company uses debt financing. Because interest expense is fixed, any percentage change in EBIT produces a larger percentage change in earnings available to shareholders. The higher the DFL, the greater the amplification effect and the greater the financial risk. In this question, degree of financial leverage equals 1.5 increase in EBIT, or net income before interest, equals 5%. Therefore, this means that a 5% increase in operating earnings results in a 7.5% increase in earnings attributable to shareholders. A. 1.5%. Incorrect. This incorrectly uses the DFL as the percentage increase instead of multiplying it by the EBIT change. B. 3.33%. Incorrect. This value results from an incorrect calculation and does not reflect the leverage relationship. C. 5%. Incorrect. If there were no financial leverage, DFL equals 1, earnings would increase by the same percentage as EBIT. D. 7.5%. Correct. Applying the DFL formula, 1.5 by 5% equals 7.5%. Shows that shareholder earnings increase by 7.5%. Correct answer, D. 7.5%. Key takeaway: the degree of financial leverage magnifies changes in shareholder earnings. A DFL of 1.5 means that every 1% change in EBIT produces a 1.5% change in earnings available to shareholders, so a 5% increase in EBIT leads to a 7.5% increase in shareholder earnings. This question examines the concepts of operating leverage and financial leverage and their effects on earnings before interest and taxes, EBIT, and earnings per share, EPS. Operating leverage arises from fixed operating costs and determines how sensitive EBIT is to changes in sales. Financial leverage arises from fixed financing costs, interest expense, and determines how sensitive EPS, or earnings available to shareholders, is to changes in EBIT. A company using debt financing has fixed interest obligations. Therefore, when EBIT declines, interest expense remains unchanged, causing net income and EPS to decline by a larger percentage than EBIT. This magnification effect is the essence of financial leverage. Students should also recognize that financial leverage affects EPS through interest expense, but it does not affect EBIT, since EBIT is calculated before interest. Operating leverage influences EBIT, while financial leverage influences the translation of EBIT into EPS. A. For a company using debt financing, a decrease in EBIT will result in a proportionally larger decrease in EPS. Correct. Because interest expense is fixed, a decline in EBIT causes an even greater percentage decline in earnings available to shareholders and EPS. B. A decrease in the financial leverage of a company will increase the beta value of the company. Incorrect. Lower financial leverage generally reduces financial risk and beta, not increases it. C. If Company A has a higher degree of operating leverage than Company B, and Company A offsets this by using less financial leverage, then both firms will have the same variability in EBIT. Incorrect. Financial leverage affects EPS, not the variability of EBIT. D. Financial leverage affects both EPS and EBIT, while operating leverage only affects EBIT. Incorrect. Financial leverage affects EPS, but does not affect EBIT, which is measured before interest expense. Correct answer, A. For a company using debt financing, a decrease in EBIT will result in a proportionally larger decrease in EPS. Key takeaway: financial leverage magnifies the effect of changes in EBIT on EPS. When EBIT falls, companies with debt financing experience an even larger percentage decline in shareholder earnings because interest costs remain fixed. This question tests knowledge of solvency ratios, which measure a company's ability to meet its long-term financial obligations. Unlike liquidity ratios, which focus on short-term obligations, solvency ratios assess the firm's long-term financial stability and dependence on debt financing. One of the most commonly used solvency measures is the debt-to-total assets ratio. This ratio indicates the proportion of a company's assets financed through debt. A higher ratio implies greater financial leverage and potentially greater risk, while a lower ratio suggests stronger long-term debt-paying ability. Students should distinguish between liquidity ratios, such as the current ratio, activity ratios, such as asset turnover and working capital turnover, and solvency ratios. Since the question asks about long-term debt-paying ability, the most relevant measure is one that evaluates the company's overall debt burden relative to its asset base. A. Working capital turnover. Incorrect. This activity ratio measures how efficiently working capital generates sales and does not assess long-term solvency. B. Asset turnover. Incorrect. Asset turnover measures how efficiently assets generate revenue, not the ability to repay long-term debt. C. Current ratio. Incorrect. The current ratio measures short-term liquidity, focusing on current assets and current liabilities rather than long-term obligations. D. Debt to total assets ratio. Correct. This solvency ratio measures the proportion of assets financed by debt and is one of the best indicators of a company's long-term debt-paying ability and financial risk. Correct answer, D. Debt to total assets ratio. Key takeaway: the debt to total assets ratio is a key measure of long-term solvency because it shows how much of the company's assets are financed through debt. Lower debt relative to assets generally indicates a stronger ability to meet long-term financial obligations and lower financial risk.